Broadcast is now starting. All attendees are in listen-only mode.
Good afternoon or good morning, all. Thank you for joining. We're just going to take 1 minute here for folks to join in, and then we'll dive right in. For any of you that are on now, we will be recorded. This webinar is going to be recorded, so we'll be sending it out after if you do have to leave early or want to listen to any information again. All right, we'll get started here. So thank you again for joining us. This is our second webinar of October, and today we will be discussing student loans and debt in general. Joining me today is Joe McGrath of GradFin. I'm excited to have Joe return for another webinar. Joe and his team help individuals and families to navigate the loan space. And I will say from experience, Joe and his team are a tremendous resource to our clients, and we'll talk about some of their services later on. We're excited to share that what we've prepared for you. And as you can see on this slide, I just want to share with you the agenda for our presentation. As I say during every webinar, if you have any questions while we're going through it, feel free to throw those questions in the chat box, and we'll be monitoring that. And without further ado, we will get the show on the road. All right. So first things first, saving versus paying down debt. Debt has been, and interest rates have been a very popular topic in the media and the news these days. And a lot of people are asking about, does it make sense to be paying down my debt quickly or be putting more money to savings? The one thing I just want to be clear on is what I'm saying here is not like don't put money towards your debt at all. This is just about when you have extra money, should I be putting it towards savings or putting it to pay down debt? And this picture on the right side of the screen is how a lot of people feel. And if you're feeling this way, you're certainly not alone. And my answer today to your situation, if you're sitting there listening, is it depends. And there is a financial piece to saving versus paying down debt, and there's also an emotional piece. I will tell you from experience with clients, there are some folks that all the numbers make sense for them to try to get to retirement to save more. However, it just makes them sleep better at night to pay down debt. On the flip side of that, it may make sense for them to pay down that debt, get rid of that bad debt, but they're like, you know what, I want to save for a home. I want to do that quickly. So what I do want to share is some things that you can be considering if you're thinking about this scenario. And I want to be clear that everything has a trade-off. So number one, have you built an emergency fund? Emergency fund is critical. We find that if you don't have an emergency fund, and let's say perhaps you pay down a credit card debt, you get into a fender bender or something like that where you're not insured, that money is coming from somewhere. Maybe you have to go to the credit card again to pay off what you owe to that other person. Emergency fund's critical. Current interest rate. So really assessing, there's all different types of debt, and then there's all different types of interest rates that go along with that debt. So we typically see bad debt being at 7% up to double digits, whereas anything lower than that being good debt. So that's something you want to make sure you figure out what your debt is, good or bad. Types of rates. So do you have a fixed rate that you've locked in for a 30-year period, or maybe it's 10 years, or is it variable? Is it coming up on a time where that interest rate is going to change and maybe your payment is going to go up? That's something you want to figure out. And maybe if it is going to go up a lot more, maybe you want to think about either a refinance or paying down that debt. Are you looking to take out another loan soon? So when I say this, typically when you go to purchase a home or purchase a second home, they're going to look at your debt to income ratio. That's just one piece in how they determine what your credit's going to be or your interest rate's going to be. So it may make sense to pay down that debt faster so that that number can look a lot better. How close are you to retirement? As I said before, that example of someone who's trying to save for retirement, they want to expedite their savings to make sure that they can live the life they want to live in retirement instead of paying down their mortgage completely. Next one here, employer match. Getting that free money from your employer. Putting just up into the match and then continuing to save, continuing to put money towards your debt. Order of operations. So this doesn't, everyone's situation is different, and not, what I do know is that all of these things don't have to go one by one by one. But for the most part, what we recommend with clients is first, again, setting up that emergency fund. Number two, making sure you have protection in place for all the what ifs that can happen in your life. Number three, paying down that bad debt. If it's that credit card debt of being at 20%, anything in that double digits or that high single digits is what you want to look at. And then you can also save at the same time. Then from there, once you've eliminated that bad debt, accelerate the savings and continue to pay off your debt that may not be as bad. So that is in the order of operations of how we look at it, what we typically recommend when it comes to saving versus paying down debt. Next thing, benchmarks when it comes to debt in general, which we're going to start to get into here, speaking specifically to debt. A good rule of thumb or a reference point is having less than 28% of your gross monthly income going towards your total housing. And then debt in general, having less than 36% of your total debt, meaning your housing, cars, student loans, and personal loans, is something you should be targeting, trying to get below. So when you're looking at your budget, you want to make sure you keep these numbers in mind. And for those of you who are trying to do the quick math for yourself, I thought it might be helpful over here for some round numbers. Depending on your income, over here on the right, your monthly income, if you're making $100,000, this is pre-tax, and you're $8,333, excuse me. You can see this numbers here of what's 28% and what's 36% based on your current situation. So just wanted to share that on the front end, and I can answer any questions that you have towards the end, or I will check the chat on this. I will turn this over to you, Joe.
Yeah, thank you, Andrew. Appreciate the time today. Yeah, but what I want to cover is just basically what's going on in the landscape of student loans today. Let me share my screen here. Actually, Andrew, can you see my screen?
We cannot see it just yet.
Okay, give me one moment. There we go. Sorry about that.
Perfect.
Awesome. So what I wanted to cover.
It says connected to go to webinar right now.
Now we should be good.
Here it comes.
Okay, sorry about that. Working off a new laptop, so it's always a little bit of an issue here. But awesome. So yeah, what I wanted to cover today, everyone, is basically as the top header here of the slide says, just a state of the union with regard to student loans. A lot of uncertainty going on right now with all of the forgiveness proposals being rolled out, updates to public service loan forgiveness, and certainly just some background education in terms of what type of options are out there for individuals who've taken out student loans and want to know about the flexibility of repayment, options to extend or shorten loan terms, And basically what I'll run through today is just some examples there, and then giving everyone an update of where we are and just giving them some talking points as to where people can go to look into student loan options. So basically, first thing here, this slide I use in all my presentations. I think it's a really good touch point in terms of giving people numbers, some stats that might open some eyes in terms of the issues that student loans face today. But 70% of 2021 graduates have student loans, and undergraduates typically carry 6 to 12 different loans by the time that they graduate. And 45 million people currently have student loans. And that totals $1.75 trillion in outstanding balances of student loans. And you see the upward trajectory here from $300 billion in 2003 to $600 billion in 2007. Some average balances upon graduation: undergrads around 36,000, lawyers 165,000, and dentists 305,000. And then the stat that I think is most important is 90% of borrowers do not know what their interest rates are. A lot of you may be sitting on this call right now. You may have just graduated. Your loans may still be in the 6-month grace period, and you may not know what the situation is. Or what's much more prevalent is individuals who have federal student loans that have been frozen since March 2020, and you haven't had to worry about making a payment on your student loans in the last 2.5 years. You may have forgotten, or you may have not even known up to that point, what the details of your loans were, what type of loans they were, certainly the interest rate as well. When in actuality, a lot of options are available to individuals to get creative with how they pay off their student loans. It does not need to be as daunting as it may seem at face value. And participants can save about $40,000 over the life of their loan by working with GradFit. But with that said, let's move on. So one of the key things that's been rolled out in the last few weeks is the student loan relief plan. Oops, sorry about that. And it's a number of different things. One is the suspension of federal student loan payments has been extended through the end of this year. For those of you unsure what that is, for federal student loan borrowers, since the outbreak of the pandemic back in March 2020, federal student loans have been frozen. They have not been accruing interest, and monthly payments have not been owed on them. And that's been ongoing since then. It's kept getting extended until now that they announced what the forgiveness relief package will be. So borrowers with federal student loans under the Department of Education, their interest rates are set to 0%. Monthly payments were automatically suspended. And during this period, $0 payments count as qualifying payments towards public service loan forgiveness. So that means individuals pursuing income-driven repayment plans, which we'll cover in a few slides, especially those pursuing public service loan forgiveness, should not be making payments during this time. And borrowers can get refunds on the payments they made during the COVID period. And you see here I said pause, tentatively pause. There has been some pushback with the student loan relief plan, which I'll cover in this slide, that may extend that federal student loan freeze. We're in a wait and see period right now in terms of whether or not that will happen. But what we do know is that it could go all the way to the Supreme Court, so things could get extended out a little bit. Just something to keep in mind, and there'll certainly be many headlines about it as that continues to go through. But what this student loan relief plan was a couple different things. One, it was a $10,000 federal student loan forgiveness for individuals making below $125,000 personal income, or if they filed jointly with a spouse, the household income would need to be less than $250,000. That was taken off the gross adjusted income that they had. And individuals who had a Pell Grant would actually get an additional $10,000 for a total of $20,000 forgiven on their federal student loans. The application has launched, and despite the rollout of the relief getting pushed back, the application is still live. And individuals who are not sure, maybe there's some issue with their taxes or something like that, and they're not sure if their income would necessarily reflect being below $125,000, even if they're actually pulling in less every year. The easiest way to figure out if you're going to get this is to actually just apply. You see the application is open, but the debt discharge is paused as a result of the court order. We are temporarily blocked from processing debt discharges, but we encourage you to apply if you are eligible. We will continue to review applications, and we will quickly process discharges when we are able to. And you will not need to reapply. So that's something really important there. And what's important to take into consideration here is just how easy this application is. Just your name, social security number, date of birth, phone number, email, and then you would click the box that you affirm that you are in the situation where you're below that income threshold. And once you do that, literally takes less than 2 minutes to fill this out, then you're done. And the idea is, even though everything is paused, they will get back to individuals, letting them know if they are approved or not. The approval rate there, it remains to be seen if it really is as simple as being below $125,000 or $250,000. But that's all you need to do. And once you've done it, you've checked that box. So it's literally no risk whatsoever to apply for this. It's worth spending the 90 seconds, frankly, to do. But again, they could not have made that simple. So here, this is a review of Pell Grant. The easiest way to figure out if you have a Pell Grant or not is actually just to log into your federal loan provider and click on Loan Breakdown, and it will tell you right there if you have a Pell Grant or not. But if you're unsure what that is, a Pell Grant is a form of need-based financial aid that does not need to be repaid. It's given to individuals who demonstrate a financial hardship when they're trying to originate their student loans. It's awarded by the Department of Education to help low-income students pay off their college costs, including tuition, fees, room and board, and other educational expenses. The first step to receiving a Pell Grant is completing and submitting your FAFSA. A family's information on the FAFSA, including income and number of children enrolled in college, is used to generate a number known as the Student's Expected Family Contribution, or EFC, to determine whether or not they are eligible for a Pell Grant. The maximum last year was about $6,500, and the lowest was $650. 34% of individuals across the country who take out student loans have a Pell Grant, and 90% of Pell Grants are awarded to students whose family's annual income is below $60,000. And by reviewing your aid file, like I mentioned, we can help you identify if an individual had a Pell Grant. But I always say,
Joe, just quick,
go ahead.
we just have a question here. I just want to
Sure.
start while it applies. So if you are applying for PSLF, should you also apply for the new $10,000 loan forgiveness?
So they're one and the same. If you try to apply for either, it's that in cap. This relief also includes those who have a Pell Grant. So it's both those who did and did not have a Pell Grant. The Pell Grant's given when you actually try to originate your student loans. So this is for individuals who currently have and are in repayment with their current loans, not the ones trying to originate.
Okay, thank you.
Mm-hmm. So very common starting point for individuals who are just finishing up university and they know their loans are going to go back into repayment in a number of months. There's a 6-month grace period after you graduate before your loans actually kick in. And what you want to do is understand your loan options. And there are 3 of them. Your employer is a key factor, and that determines whether or not you're eligible for something like public service loan forgiveness. If you're not sure where you're going to work, if you're not going to be working in a 501c3 or a nonprofit or a public entity, law enforcement, et cetera, you want to look into preserving that public service loan forgiveness option and minimize accruing interest. And then finally, if you know you're going to work in the private sector and you're not going to have any relief options beyond the application for the $10,000 forgiveness, you're going to want to look into refinancing your student loans. So first, let's look into the income-driven repayment plans. These are a very common repayment option for a couple different situations. One, individuals, like I said, who are not sure if they're going to work for a public service loan forgiveness eligible employer, or if they are not going to be making that much money the first years out of school and they want to make sure their student loan payment is a little bit more manageable. That's when you want to look into income-driven repayment plans. So some typical situations called delaying term repayment is using an income-based repayment. And why would you want to do that? Well, one, you may be going to not necessarily dental, but a regular residency. Like I mentioned, your affordability is not quite there yet. Maybe you want to buy your own private practice or do something a little bit more entrepreneurial. You're not comfortable with your current job, or you're just not sure what the government's going to do. That's when you look into these. So what is income-driven repayment? Income-driven repayment is a repayment plan that ignores the functionality of existing loans and calculates payments that are determined by your state of residence, your family size, additional outstanding debt, your marital status, and it's largely driven by a percentage of your discretionary income, i.e. your gross adjusted income. And these are the 4 main ones right here. The revised pay-as-you-earn, income-based repayment, income contingent repayment. You are not obligated to know the difference between these. That is why you would use a term of service like GradFin, because these programs are very complicated. I've been working with these day after day for the last 5 years, and if I was forced to name every single difference between every single one of them, I would have trouble doing it. That's how that is how complicated they are. But one important thing that is good to know is they are used, like I mentioned, for individuals who want to have a lower monthly payment after they graduate, have a little bit of breathing room, and they're ideally used for individuals who are planning to get off of them later on. These programs have a 20 or 25 year forgiveness attached to them, but it is considered taxable at the end. So it's a cash event that you would need to prepare for, as opposed to something like public service loan forgiveness that we'll cover, which is not taxable. These on their own, the loans will be forgiven. We will need to save up some money in order to prepare for that tax hit. That's why you only really would want to use it unless you're pursuing public service loan forgiveness for a few years. And then you can look into going, consolidating your loans into a regular repayment or refinancing them to a private loan. One of the most common ones is revised pay-as-you-earn. Revised pay-as-you-earn has a couple different advantages. One, the biggest advantage of revised pay-as-you-earn is that the program comes in the form of an interest subsidy for both subsidized and unsubsidized loans. On subsidized loans, you do not have to pay the difference between your monthly payment and the amount that accrues with interest, or the amount of interest that accrues, rather. I'm sorry. And on unsubsidized loans, you only have to pay half the difference between your monthly payment and the amount that it accrues. What's the disadvantage? Well, the largest disadvantage is that the calculation of monthly payment for a married individual and the 25-year term for graduate students, your payment will be based on a combined income and the loan debt of you and your spouse, regardless of whether you file joint or separate on your tax return. So basically what this means is, you may have to have an inflated monthly payment on your student loans if you are married. But again, I say all that to say, these programs have very subtle nuances between them. So it's important to consult with an expert to see what the best one is for you, because how you file your taxes, how much money you make, your plans for being employed, if you would want to stay in the job for a certain amount of time, all have really, really big implications on how these loans are calculated over the course of a payment. So public service loan forgiveness is a very common option for individuals. Doctors, nurses, public school teachers, law enforcement, military, 501c3 nonprofit employees all have this program available to them, among others, government workers as well. And to just not really necessarily use the jargon here, what it is a incentive for individuals to stay employed for these in these companies for 10 years. And at the end of the 10 years, the remaining balance on their loans is forgiven. Typically, it can be a pretty substantial amount, and you pay a really reduced monthly payment. And as opposed to the income-driven plans, like I mentioned before, these programs are forgiven tax-free. So your loans are literally wiped away after 10 years if you've done everything correctly. But there is a large rejection rate for this program. 95% of individuals who complete the 10 years get rejected for forgiveness at the end. Why is that the case? Well, loans fell out of good standing with the program, annual certification was not completed properly, borrowers are not in the right repayment plan, and qualifying payments for the program are not counted properly. So if you are employed for one of these organizations, you may have heard about the waiver. It actually expires on Halloween, this upcoming Monday. But the good news is there is an update on it that I'll cover in a second. But what this waiver does, it actually acts to address that large rejection rate in the slide above. And what it is, it allows you to consolidate your loans and get many retroactive payments back. There's a lot of hoops you need to jump through, but the short version of it is it just simplifies individuals' ability to get loan forgiveness. Whether they worked for a qualifying employer in the past and get those months counted, even if they're not working right now. And active duty military borrowers, while on deferment or forbearance, will actually get the forgiveness as well. Payments made before consolidation are now eligible. That means if your loans were not in an income-based repayment plan, which is required for public service loan forgiveness, you can consolidate them into an income-based repayment plan, and they will all retroactively count towards the forgiveness. And now any repayment plan under that banner is eligible. Like I mentioned, this waiver is expiring on Monday, but the good news is you're not out of luck, because if you didn't act on it in the year that it's been open, they're going to reopen it in next summer, in July. And it'll allow you to take advantage of that as well. So that's something to keep in mind. The actual details of this waiver, the one that reopens, may have some differences between the one that's open right now, but we will certainly let individuals that work with us know as soon as we have the further details there.
And Joe, we just have one quick question here. Someone asked,
sure.
I worked less than 10 years at a nonprofit. Do I qualify for PSLF?
One more time, sorry. Repeat that. You broke up a little bit.
I worked less than 10 years at a nonprofit. Do I qualify for PSLF?
You would qualify for PSLF and you would be able to get those months back, but you would need to satisfy 10 years of employment in order to actually get the forgiveness. So if you move to a private employer, you will not be able to get those months counted. However, if you did go back and if you did move positions and actually work for a qualifying employer after this, you would be able to get it utilized in the waiver.
Thanks, Joe.
Absolutely. And these are some public service loan forgiveness success stories here. We've gotten as many of 10 years of payments back. That would actually be similar to the situation, the question just now. We'd be able to get 120 months back of qualified payments. We won over 260 appeals with the Department of Education. We work with 1,400 companies in order to assist their employees with public service loan forgiveness. We average about $115,000 in forgiveness for individuals. And we've had over $10 million in forgiveness, with the highest amount being $416,000. So if you didn't want to look into the federal options, there is always the option to consolidate and refinance your student loans. How you're evaluated for refinance and what are the numbers I'll cover in a moment. But the other one here is some of the pros and cons of consolidation. Consolidating is a very permanent option. I always say you can refinance your times as many times as you like. You can only consolidate your loans once. That's the difference there. Consolidating your loans is lumping them all together into one loan and one monthly payment. The pros there is it simplifies the payment every month. And if you have a low number of loans, it can actually make you pay less over the life of the loan. Not always, because there's actually a con attached to that as well. But it's there to simplify things. It allows you to get into compliance with things like public service loan forgiveness. It allows you to utilize different repayment options in order to simplify them, or even lower the monthly payment on your student loans. So consolidation is a great option if it makes the most sense for you. And the one thing about student loans, I say every situation is like a snowflake. Everyone has their own specific situation, making their own, making money, making a certain amount of money, or having a different loan breakdown. So, it really depends on the situation that is very, very specific to you. Some of the cons, you don't want to be looping too many loans together. You might end up paying a lot more over the life of the loan by doing that. You lose a lot of considerations with consolidating your loans as well. You may not be able to use certain repayment options. So, for as many pros, there are also cons as well. But again, it's why it's specific to people's situations. But for refinancing, why would you want to do that? Well, it's a permanent rate reduction, and it creates opportunities. The idea is to free up cash flow. There's no origination fees in student loan refinancing. You can refinance as many times as you like. Over the course of the last 2.5 years, when rates continued dropping, we were going back to the well and refinancing many people in order to make sure they were in the best possible situation, with rates that have been the lowest they've been in years. And we track all of those, refinancing, and we notify individuals when market opportunities arise. How are you evaluated for refinance? Well, there are 5 key things. 1, your income. You want to make as much as you can, but obviously you don't control that. Your debt to income ratio. Individuals at Grafton will actually calculate this for you, so you don't have to worry about it. But it's just an idea of how much you make versus what you pay in your bills each month. Credit cards, rent, car loans, etc. Your credit score, which you always want to monitor and make sure you're paying off your credit cards each month and making minimum payments at the very least. Savings, you want to save as much as you can. That's why you work with someone like Andrew who can help you there. And education, which obviously you have low control over, but that is taken into consideration as well. And Andrew, I'll pass it on over to you for this slide.
Yeah, for sure. I will share my screen here. Okay. Okay. So we talked a lot about student loans, and I'm going to talk a little bit about debt in general and what we're seeing out there in terms of, we'll start with rates. So mortgages, as of yesterday, the 15-year fixed had an average of 6.44%. 30-year fixed, 7.22%. And a 5/1 ARM, which is an adjustable rate mortgage where the rate will change after 5 years, at 5.53%. For those of you who don't know this, or perhaps maybe weren't alive during this time, in 1981, the average 30-year mortgage was 16.64%. So although they may seem like they're higher now, pretty incredible to see that. Personal loans. So they've reached an average of about 10%. Auto loans, if you have excellent credit, we're seeing typically, and again, as Joe mentioned, there's many factors that go into this, but on average, credit above 750 was just below 10%, and good credit just below 750 was just above 10%. So again, you want to make sure you talk with a professional and don't let any of these necessarily the interest rates scare you. Just make sure you verify what you could get for an interest rate if this is something you're looking into, and don't let that stop you necessarily from buying that car that you want, but you want to be strategic with it. When I say strategic, one of the things that come to mind is loyalty programs. So for any of you who work with, say, a Bank of America or Santander or whatever bank it may be, times like this is times where you want to take advantage of being that loyal customer. Typically, they'll offer lower percentage interest rates, and you want to make sure you look into that at your bank. What happens during these times is you see a little bit of a race to the bottom where banks are willing to take risks, they'll lower interest rates so they can take on new clients. And you just want to go back to your bank because they know that and say, what could you do for me? Sometimes there's flexibility, sometimes there's not. But you want to make sure you look at that in times of rising interest rates. Other things that we're seeing out there are prices of homes are coming down. If you're in the market right now, it may not seem like that home that you love just doesn't want to go down. But we are seeing that mortgage and housing demand is at a 25-year low. Folks are using things like adjustable rate mortgages and interest-only loans to get that financing. Now, I'm not making any recommendation for an adjustable rate mortgage or an interest-only mortgage. It could be an option for you, but you just want to make sure you talk with a professional about this for your situation. All of those options allow you to get into your perhaps dream home and not have as much cash flow going towards your mortgage. But you want to be careful here because you don't know what it could look like down the road, what interest rates could be, and you don't want to get yourself, you may be super happy now, but you might be caught in a tough spot down the road. But all these things need to be thought through. So let me go to the next slide here. Joe, if you want to run through this, talk a little bit more about the tools you can share with our participants.
Absolutely. So the key to how we work with individuals and our product that's wholly unique to us is our consultation. And it's individuals meeting with a member of our team where we can analyze their new and existing student loans to find the perfect repayment plan for their financial goals. And obviously that includes seeing if you're eligible for the $10,000 or $20,000 consultation. These consults are fee-free. We do not charge for these half-hour consultations. We get paid mainly through the banks that we work with as a broker when we help execute individuals' refinancings. We get paid on a back-end spread. So that's why we're able to not charge for these consultations. The only time individuals who work with us will ever be charged for anything is if they enroll in our public service loan forgiveness membership program, which I have in another slide and I'll cover. But everything else, education, advice on how to consolidate, walking them through that, refinance, all fee-free. And our goal is to free up cash flow. If we're able to save up some money, like I mentioned at the top of the presentation, average borrowers by working with us save about $40,000. That's a positive cash flow for investing, purchasing insurance, and then finally just improving your financial health. Who doesn't want some more money at the end of the day? We have 11 different banks on our platform that we work with. It allows us to have an 88% closing ratio. Other lenders are in the 20 to 30% range because they aren't brokers. They have their own specific set of rules. and low interest rates. Current interest rates in the situation still has historically low rates. They're not exactly where they were the last 2.5 years, that's saying the very least, but they are just about where they were in March 2020, which was a pretty solid time. 5 to 7% for 5 to 20 years seems to be the norm. But obviously, interest rate isn't always the only thing you should look at when refinancing your student loans. When looking at your student loans, when refinancing your student loans, it's very important. Sorry, I misspoke there. For refinancing, interest rate is very, very important. But on the federal side, and for options like public service loan forgiveness education, key thing I want people to walk away with is that it's really important to know you have a lot of flexibility in your repayment of your student loans by just moving from a direct 10-year payment to an income-based repayment or a graduated or extended repayment. All of that Gradfin can walk you through. And then our public service loan forgiveness membership. Andrew, if you want to go to the next slide. So this is what we use for our fee-based membership program for public service loan forgiveness. Again, it's $250 per year to individuals to get enrolled, but it's designed to gain compliance, navigate the complex rules, and help individuals with the paperwork, prevent major mistakes and avoid rejection, and create peace of mind by working with our team of experts. We do that by auditing past payments to make sure they count as qualified payments. Remember, this program has a 95% rejection rate for forgiveness. Appeals process of the Department of Education. We've won many, many appeals with the Department of Education to help people get qualified payments counted. Personalized compliance plan, annual review, secure online portal. Remember, we're going to help with that waiver that is available, and access to our team of experts. And things like webinars, annual reminders, 30-minute time slots Monday through Friday are all part of the services that we offer. Next slide works. So next steps, everything's actually done through Andrew. Andrew's the guy that can set up these consultations with you. He'll introduce you to me. I assist him with all of his clients with their student loans. Basically, you would go to him, he would introduce you to us and get you set for a consultation. And we'll have you upload your loan statements after the call is scheduled, and you'll be good to go from there. My contact information will be at the end of this presentation. We'll set you up for the consultation. We'll see if you can get the $10,000 or $20,000. We'll look into whether or not it makes sense to refinance, or if we are going to refinance and you can get the forgiveness, keeping $20,000 or $10,000 in your balance. And then finally, seeing if you would work for the public service loan forgiveness membership, seeing if you apply for the waiver, and working from there.
Okay. And one thing I will say for those that are listening is, in my experience with all our clients that we've referred to Joe, they are not sales folks. They take a consultative approach, and personal loan forgiveness might not be something that you could get, but you certainly would want to go check that out, and they're going to help you along that way. And I've had many folks that come back and say, listen, they told me that maybe it wasn't right to refinance, or maybe it wasn't right to consolidate. They're not just looking for a sale. So I just want to make that clear, and thank you, Joe, for what you do in your team.
Absolutely. Thank you for having me on.
So I have, we've answered all of the questions in the chat here. We have one person who was looking to, who had asked for some more info who you would speak to. So feel free, you can reach out to myself at andrew@12points.com. And I can get you hooked up with Joe and his team. And you guys can have a introductory conversation. If you have any questions here, I'm just going to keep monitoring the chat. Thank you all for participating. And we hope to see you at our next webinar next month. Thanks, Olivia. All right. Take care, everyone. Have a great day.